I expect things to be just at a macroeconomic level difficult for at least the next 12 months.
Elon Musk, in the latest Tesla shareholder meeting, said that he expects economic downturn in the next 12 months. In this video, we are going to be talking about Warren Buffett's advice on how to invest during a recession. According to Warren Buffett, recession is the best investment opportunity. In 2008, during the great financial crisis, he wrote, "Bad news is an investor's best friend. It lets you buy a slice of America at a fractional price." Moreover, Warren Buffett advises investors to invest using a long-term focus. He said that investors who avoid high and unnecessary costs and simply sit for an extended period with a large collection of large, conservatorily financed American companies will most certainly do well. He says businesses will indeed suffer earning hiccups, as they always have, but most major companies will set a new profit records for 5, 10, and 20 years from now. To illustrate this point, let's talk about Warren Buffett's greatest investment, Coca-Cola. In 2007, right before the Great Recession, the Coca-Cola share price peaked at around $32. In March of 2009, Coca-Cola shares were trading at $19.55. The main point is what truly changed about Coca-Cola as a company in a year and a half. Coca-Cola still was an amazing company, a very globally recognizable brand with amazing moat. So what changed? What changed was the market sentiment. People were simply too fearful about the economic future. However, people who looked past that fear and bought Coca-Cola shares during that time, today as I'm making this video, is trading around $63 per share. Buffett encourages confidence. In 2010, he wrote, "We're still in a recession. We're not going to be out of it for a while, but we will get out. Nothing is permanent even when it feels like this is never ending." We all have heard of Warren Buffett's famous quote that be greedy when others are fearful. Recessions are a time of fear, and this is a great opportunity for you and I to grab these shares at bargain prices. Now, what companies should you be buying during a recession? And Warren Buffett has answered that for us as well. Warren Buffett attributes his and Charlie Munger's getting rich to Chapter 8 and Chapter 20 of The Intelligent Investor, written by Benjamin Graham, who is Warren Buffett's mentor.
The beauty of stocks is they do sell at silly prices from time to time. I mean, that's how Charlie and I have gotten rich. You know, Ben Graham writes about it in Chapter 8 of The Intelligent Investor. Well, Chapters 8 and Chapters 20 are really all you need to do to get rich in this world. And Chapter 8 says that in the market you're going to have a partner named Mr. Market. And the beauty of him as your partner is that he's kind of a psychotic drunk. And he is making lots of mistakes. So it's built into the system that stocks get mispriced. And if you make your buy and sell decisions based on what you think a business is worth, and you stick with businesses that you think you've got good reason to think you can value, you simply have to do well in stocks. It's a marvelous game. I mean, the rules are stacked in your favor if you don't turn those rules upside down and start behaving like the drunken psychotic instead of the guy that's there to take advantage of him.
Warren Buffett said that these two chapters allowed him and Charlie Munger to be rich. Chapter 8 is titled The Investor and Market Fluctuations. In this chapter, Benjamin Graham talks about how investors should approach market fluctuations. Benjamin Graham talks about having a long-term focus as opposed to trying to time the market or focus on short-term price movements. Benjamin Graham talks about doing your own research and analyzing the true intrinsic value of a company by using underlying factors such as earnings, asset, future projections. He talks about purchasing these companies when the market price is far below the true intrinsic value of a company. By buying these shares at a discount price, you have positioned yourself as an investor to profit off long-term gains when the market eventually recognizes the true value of a company. Moreover, this chapter talks about not to be swayed by market psychology. This can lead to irrational and speculative investing. Moreover, rather than following the crowd, an investor should do their own research and make more informed investment decisions. Now, let's talk about Chapter 20. Chapter 20 is titled Margin of Safety as the Central Concept of Investment. Graham introduces margin of safety, which is the buffer between the true intrinsic value of the company, the market price, and the difference in between. The larger the difference, the more margin of safety you have. He urges that investors should have a good margin of safety before making informed investment decisions. Benjamin Graham says that this margin of safety protects investors from potential losses and unforeseen circumstances or errors in your judgment. So in summary, Chapter 8 talks about how investors should have a long-term focus since it is very difficult to consistently profit from short-term price changes. It is also very important to do your own market research and make informed investing decisions. Chapter 20 talks about the margin of safety. If you do your own research, you will understand the true intrinsic value of the company and the market price and have a good margin of safety to protect yourself from potential losses or an error in your judgment. What if you do not have the time or the skill set to calculate the intrinsic value of the company by looking at the earnings, assets, future projections, trying to see what is happening in the market? If you don't have the time for that, Warren Buffett has an answer for us for that as well. In 2020, during the shareholder meeting, Warren Buffett said, "In my view, for most people, the best thing to do is own the S&P 500 index. There are huge amounts of money people pay for advice they really don't need. If you bet on America and sustain that position for decades, you would do far better than buying treasury securities." Over the past century, the S&P 500 have returned 6.9% return with inflation adjusted. Investors can buy into the S&P 500 index fund every month, which we call dollar cost average, a specific amount regardless of what the market price is for the next 12 months, and are more likely to succeed without doing any market research. Now, apart from stock market analysis and investing, Warren Buffett has also provided another piece of advice to invest in yourself during times of economic downturn. Warren Buffett says, the best thing you can do is to be exceptionally good at something. People are going to give you some of what they produce in exchange for what you deliver. Education and skills that you acquire and invest in yourself are recession-proof, thereby increasing your income and allowing you to invest more money into the S&P 500 index. So I hope you liked this video and got something out of it. Please let me know your feedback, and if you like this video, please like and subscribe and leave a comment below on any improvements or anything else that I missed in this video. Again, a quick reminder of to be greedy when others are fearful. If Elon Musk said that these 12 months he expects economic downturn, it is honestly very, very likely. So please do invest into the S&P 500 on a regular basis. And yeah, I hope you like this video, and I shall see you in the next one. Bye!